Supporting the matching principle. This segment's learning objective is to explain how the principles of realization and matching relate to adjusting entries. Adjusting entries are the tools by which accountants apply the realization and matching principles. Through these entries, revenues are recognized as they are earned, and expenses are recognized as resources are used or consumed in producing the related revenue. Adjusting entries are how accountants apply the realization and matching principles. Through these entries, revenues are recognized as they are earned, and expenses are recognized as resources are used or consumed in producing the related revenue. In most cases, the realization principle indicates that revenue should be recognized at the time goods are sold or services are rendered. At this point, the business has essentially completed the earning process, and the sales value of the goods or services can be measured objectively. At any time prior to sale, the ultimate sales value of the goods or services sold can only be estimated. After the sale, the only step that remains is to collect from the customer, and this is usually a relatively certain event. The matching principle underlies such accounting practices as depreciating plant assets, measuring the cost of supplies used, and amortizing the cost of unexpired insurance policies. All end-of-the-period adjusting entries involving expense recognition are applications of the matching principle. Costs are matched with revenue in one of two ways: direct association of costs with specific revenue transactions. The ideal method of matching revenue with expenses is to determine the actual amount of expense associated with specific revenue transactions. However, this approach works only for those costs and expenses that can be directly associated with specific revenue transactions. Commissions paid to salespeople are an example of costs that can be directly associated with the revenue of a specific accounting period. Systematic allocation of costs over the useful life of the expenditure. Many expenditures contribute to the earning of revenue for several accounting periods, but cannot be directly associated with specific revenue transactions. Examples include the costs of insurance policies and depreciable assets. In these cases, accountants attempt to match revenue and expenses by systematically allocating the cost to expense over its useful life. Straight-line depreciation is an example of a systematic technique used to match the cost of an asset with the related revenue that it helps to earn over its useful life.